Denied Stones Productions presents Garden of Praise with your hostess and producer, Cookie Price-Drayton. Psalms 118:21 through 23 proclaims, I will praise thee, for thou hast heard me, and art become my salvation. The stone which the builders refused has become the headstone of the corner. This is the Lord's doing. It is marvelous in our eyes. And here she is, your hostess and producer, Cookie Price-Drayton.
To the Garden of Praise. I am your host and producer, Cookie Price-Drayton, and thank you for joining us. Today we have some very good information for you. We have in the person of Claude Wallace, who is an IRS certified income tax preparer. God bless you, Mr. Claude Wallace. How are you doing today?
Thank you. I'm pleased to be here.
Welcome to our show. Thank you for coming, because the tax season is upon us. And this is actually my accountant that I aggravate every year, and I still ain't ready. You know, I'm always the last one, running in at the last minute. But Claude is going to share some very good information with us today that's going to help us get as much of our money back as he can. Okay? Oh, Mr. Wallace, tell us now. There's taxes to me. I hear people say, oh, you can do it for free online. Hello. Would you suggest that first of all?
No, not really, because online will not take into consideration of all the intricacies that might apply to a tax preparer. I think it's best that you go to a tax preparer so that you can get a more exposed advice on the variety of tax forms that might be available to you.
Okay. Now just tell us, because you know, you're my accountant, so I just dropped my box of papers in your lap.
Yes, I noticed that you do.
And at that time, you just do your thing while I watch your TV, okay? Now, but tell us the different type of forms that there are in the tax industry, if I'm pronouncing it correctly, and who might be beneficial for each form.
Okay.
That's a small question.
But a long answer. The basic form is called the 1040S. Excuse me, the 1040. The 1040 United States Individual Income Tax Return. Regardless of what your filing status is, or what the circumstances beyond that, you will always have to file Form 1040. Okay? There's a 1040A form, which is a short form. Very simple for a single parent, maybe with a child, with child care expenses, and we'll discuss those forms. But the 1040A form is primarily designed for those who are homeowners, or those who receive Social Security, and those who may receive a pension from their job, or get an IRA distribution, and we'll go through that.
So the 1040 is the form that you mentioned, a single parent maybe with a child, anyone who has someone, a dependent. Is that correct? Anyway. See, I know that if I understand it, anybody could understand it, so that's why I might be repeating myself.
Yes, but the 1040A can also identify dependents of the taxpayer, as well as the 1040. Remember, I said the 1040A is a shorter form to fill out because you're not a homeowner. You're not paying property tax. All right?
I got you.
So if you have those two elements, you will not use a 1040A form. You will use the 1040 form.
Okay.
That's right.
All right. So those are two. That's the 1040. If you are a property owner, and the 1040A.
If you're a renter.
If you're
a renter.
A renter.
If you're a renter.
Okay.
Now, I just want to add also, since we mentioned the word renters, in the state of New Jersey and on your state form there is a section that's called for renters. And if you calculate your annual rent that you pay, you are entitled to a $50 discount on your state taxes.
Okay.
Homeowners get a relief by the property taxes that they pay.
Okay, right.
Homeowners relief is based on the property taxes they pay with the state of New Jersey. Renters is predicated on the amount of rent that you pay that will entitle you to a $50 credit.
Okay.
Okay. Now we mentioned before a Schedule A. Schedule A will also primarily relates to those who file the 1040 form, because Schedule A talks about property taxes that you pay. It also talks about the mortgage interest that you pay, and those are some of the two highest categories on your itemized deduction form. Property taxes and mortgage interest taxes. Another category for use of the Schedule A itemized deduction is your contributions to church and charitable organizations. And more often you should have a receipt from your church identifying how much you paid.
Yeah, I think the IRS is really cracking down on, church organizations because everybody got an envelope now. Put your offering in the envelope, so.
You should be able to support any dollar amount that represents your expenditures. You should be able to document with a receipt or some type of evidence for any amount that you put on your taxes which represents an expense. IRS can audit you and require you to produce it. And too many times clients will represent they paid this amount for that type of activity, and should they become audited and they can't support it, IRS will eliminate it. Okay. But Schedule A, we mentioned, is primarily for homeowners to deduct property taxes paid, mortgage interest, employees' expense such as union dues. If you travel to a conference and you don't get reimbursed, you can put it on your itemized deduction form.
But that's that would have to be travel for your job.
Absolutely.
Oh yeah.
Yes, that you
What
will
about
reimburse.
traveling back and forth? 'Cause right now I'm working on a job. I got to drive 40 miles every day.
Well,
do I get some money back for that?
Well, with questions like that, I usually respond to my clients. I said, do you know every person in the United States leave their house and go to work? They leave their job and come back home. Now, do you reasonably expect the government to give you an deduction?
Well, so then
No, they won't.
specify what travel means. What does travel mean? Going out of the state?
No, for who? For your job?
Yeah, for the job.
If you use your car for business that relates to your job, yes, you can write off the mileage that you consumed on behalf of your job. But leaving your home, going to and from work is not a write-off.
Well, it was worth a try, y'all. I tried.
Well, I use as a general rule of thumb that if it is an expense that the 380 million Americans can have incurred, then it's not going to be a write-off. Most people talk about uniforms. Well, I have to wear a shirt and tie to work. Can I write that off? Well, let me ask you. Can you wear that shirt and tie? Can you wear that shirt and tie to church? Yes, you can. Can you wear that shirt and tie and a suit out on a date? Yes, you can. Can I write that shirt and tie and the dry cleaning off on my taxes?
No, you can't.
Okay.
All right. Well.
Question so frequently asked is about, can I deduct expenses for my dog? Well, only if your dog is a seeing eye dog.
Okay.
Okay? I had one client say, well, my dog is security to my house. So can I write off his food? No, you can't, sir.
Okay.
Install an alarm system and you can write it off.
Okay. Okay.
And just let me add one more thing since we're talking about houses. If you have a one-family home, the only thing you can deduct off a one-family home is your property taxes and the interest that you pay on your mortgage.
Okay.
Any repairs? No.
Okay.
A plumber, electrician, any repairs? No, you cannot.
Only rental property.
Only on a rental property.
Okay.
That's correct. And the reason you can write off those expenses is because you receive rental income for that unit. So any expenditures that you incur to repair that apartment, to make it rentable, to make sure the water system is acting correctly, making sure that property is totally rentable. Any expenses you incur for that rental property is a tax deduction for you.
Okay. Okay. That's good news. That's really good news. But some people don't know that. I've been told for years, not by you, Claude, but you need to write every light bulb you have to change. I'm like, for real? You know? Cool, Maureen driving Claude crazy.
Go back to what I said. There are approximately 380 million people in the United States.
Yeah,
every household have a light bulb. Is that something that the government's going to allow you to write off? I think not.
So let me ask you, Claude, this, I don't even know the language, but this thing that we've been going through with the president, it's something to do with the prime something.
Well,
does that have anything to do with taxes? Because I know that all of our taxes were increased.
Well, property taxes has nothing to do with the president's reference to prime.
Okay.
Property taxes are regulated by each state in the United States. You may have heard that New Jersey is one of the highest property tax states in the nation.
Is it?
New Jersey. California, I think New Jersey is higher than California. The southern states are some of the lowest property tax jurisdictions in the state. Most of the southern states. Okay? So when you're buying a home, that's something you must consider also. What is the state's tax rate for homeowners?
And it absolutely varies, because out here in Union, we're kind of reasonable.
Well, Township of Union is,
kind of reasonable.
Yeah, it's up there.
Compared to like Roseland, I think they're paying like double what we're paying.
Well, it depends on the jurisdiction, and one thing that some homeowners are going to experience if they have not yet, which is a state regulations concerning revaluation. Revaluation. That means every 5 years, a municipality is supposed to visit every household in their jurisdiction and identify the appraisal value of that home.
Really?
And theoretically, your property taxes should be predicated on the appraised value of that home.
Wow. Okay. Now, I do know about the 5-year visit that the state, and you're supposed to actually register, well, with me, because I have a multi-dwelling. And, you know, you're supposed to register with the state.
That's right.
But, but I didn't know that they were actually reappraising your home, the value of your home.
There is a state law that requires all dwelling units to be re-evaluated every 5 years. Several years ago, the city of Newark was brought to task by the state of New Jersey because it had not reevaluated its property in more than 15 years.
Okay, okay.
So the state threatened to withhold state funding for the city of Newark until such time that they conducted their property reevaluation. And when that was concluded, most taxpayers and homeowners found out their taxes was increased anywhere from $900 a year up to $2,000 a year because their house was appraised at a higher value.
That seems unfair. I mean, but now, honestly, in your opinion, do you think that, like, if you haven't done any major repairs to your home, that they can legally appraise your house at a higher value?
Well, they will take into consideration any what we call capital improvements. Capital improvements mean if you modernized your kitchen, if you modernized your bathroom, if you put in the latest style windows. Okay, those are capital improvements which increase the appraised value of your home. If you put a fence around your home.
It would be, I mean, for your home to be valued at a higher price, that's a good thing if you're trying to sell it.
If you're trying to sell it.
But are you really going to get
what? But you have to keep in mind also, the appraised value, the market value, and the assessed value are three different things. And most often, the assessed value means what the tax collector in your jurisdiction has assessed your house at. And for many, many years, there was a grave disparity between the assessed value and the appraised value. And that's why I mean it was incumbent that the state regulations wanted the assessed value to mimic closely to the appraised value. And in a lot of jurisdictions, there was a big difference between the assessed value for which you were paying taxes on and the appraised value of the home.
I got a headache now. Let's move on with the forms.
Another forms
that's why I got your phone number.
Another form which is very critical is called Schedule B. Okay. Schedule B is simply just identify any interest income. Income. Well, as you know, in today's market, some banks are just barely paying you 2% on the money that you have in their institution.
More like charging you too.
Okay.
Charging you.
But you'll get a form from your financial institution that states what interest you received, and you'll also get a statement from any investments that you might have, which relates to the dividends that you have received. And both of those items are reported on your income tax return. Interest and dividends.
Okay.
Another form that we want to discuss, and this will apply to several households, is called the Child Tax Credit Worksheet. This is a freebie. Keep in mind, credits reduce the amount of taxes that you owe. An example that we did earlier, we talked about after all the deductions, this household had a tax of $2,000. That was the amount of taxes that they were obligated to pay. Credit reduced those taxes that you owe. So for an instance, is talk about the child tax credit. Now, any child under 16, you will get a $1,000 child tax credit.
Under 16.
Under 16. So if I owed $2,000 and I have one child under 16, now I only owe $1,000 in taxes.
Good. What happened after they get 16? Though?
After they turn 16, they are no longer eligible for that $1,000 child tax credit.
Lord, we want some better figures here. You, not that you make rules, but come on.
Well,
16?
After 16.
What about if they're still, they are going to still be in school, but because there's even something.
It's an age criteria. Child tax credit is an age criteria. But just think about it.
Mm-hmm.
If that child is 16 or 15 years old from his date of birth, you have wrote off the government has given you $15,000 in credits for that child. $15,000.
But he ain't grown yet.
Well,
he or she, right?
To my listening audience, I don't know if I can respond to that.
Well,
But let me just remind you of another form of credit. And keep in mind, credit reduces the amount of taxes that you owe. Okay. There is such a thing as child care credit. If you have your child in a daycare center while you go to work, then you should get a statement from that daycare center identifying how much you paid for daycare or nursery expenses for the year, and you will get a credit based on the amount that you paid.
Well, that's good. Okay. That's good, because I know that's a great expense also.
Yes. Usually that can go up to 20% of how much you expended in the previous year on daycare, nursery, babysitting expenses, after school expenses, those type of child care expenses. Okay.
But I'm still a little stuck on that 16. I don't know why.
On the age 16?
Yeah, because I thought that even I don't know. I'm confused a little bit because I thought even like if they stay in school, go to college, that you can still claim them.
You can. You can claim your child as an exemption or a dependent. And keep in mind, for 2012, you're still writing off $3,800 for that child over 16. Okay.
We happy now.
Okay. All right.
I was going to say 16.
No.
You know mine is grown already.
You don't lose your deduction because the child turned 16. As long as he is in your household, you can write off that exemption of $3,800.
Suppose they stay till they like 50 years old. Can you still claim them as a deductible?
If you claim a dependent, you are representing that you provide more than 51% of their annual household maintenance and upkeep. That includes rent, heat, water, clothing, shelter, all the essentials. So if you provide that to a child or a grandparent who's living in your home, then you can write them off as a deduction.
Well, that's good. That's good. That's very good.
Yes,
very good. Absolutely.
But you have to go through the dependency test, which certifies that they lived in your home for 12 months, and you provided more than 51% of their general household maintenance and upkeep.
And I'm sure it's a whole lot of people can qualify for that.
Well, if they have a person living in their home who is unemployed, then you automatically will reach that quota.
But what about if they're receiving unemployment benefits?
Unemployment benefits will not exclude you from claiming them as a dependent because they're still in your household.
Okay. All right.
Okay. And since you mentioned unemployment, just let me advise our listening audience. If you go to the Unemployment Bureau and you apply for unemployment, make sure they withhold taxes, federal income taxes, from your unemployment, because unemployment benefits are taxable. It's taxable income. You will pay taxes on it. So make sure.
And I never have. I mean, I need this little bit of money.
Yeah, but it will come out to be taxable income.
Okay, well, I can honestly say that anytime I have been unemployed, I've never had taxes taken out because, you know, and trust me, I'm here with you. I know how hard it is to live on unemployment, but, you know.
Well, I really understand that, but it's like either you have them take it out from your gross amount, or you might be prepared to pay them just prior to April 15th. The only thing that might save you from that is if you were employed for most of a year, which federal taxes had already been taken out, that might save you from the taxes you might have to pay unemployment. Okay, and just let me mention one thing since I said that. When you first start your employment, there is a form called a W-4 form.
Okay.
This form is for your employer to identify what rate of taxes will be held from your gross income. If you are a single person without a child and it's just yourself.
I'm smiling because you tell me this every year. Why are you still taking exemptions? I'm like, well, I need my money.
And if you claim, and you're single, and if you claim single with one exemption on that W-4 form,
okay,
all right, then, and you file your income taxes at the end of the tax year, and you claim one exemption, that means that you anticipate that the government has taken out enough taxes because you claim one on your job, you claim one when you file your taxes. So you're kind of saying, well, I don't owe them and they don't owe me. Well, that's too close to the vest for me. And I would rather tell my clients to claim single zero. Single zero on that W-4 form. And yes, you may not realize approximately $37 or $57 coming from your pay period when you claim zero. They're taking out taxes at a higher rate as opposed to claiming one. Okay? You claim zero, they're going to take out a little bit more taxes. But at least you're giving yourself a wider cushion for federal income tax withheld to anticipate a refund.
Now, but isn't there's a box that tells you on the form, put one if it's just you, more so.
Yes. Okay.
So why should we be disobedient there?
You're not being disobedient, you're being prudent.
Okay.
Because the tax laws can change any time during the year. Okay? Obama just made some tax law changes that has an implication on the tax rate.
And what does that do?
Well,
I mean,
it's...
I don't want you to go through the whole presidential speech, but what exactly?
It's an increase in taxes to help defray the deficit that the United States is in. Okay? So the government gets a little bit more money. That's a little bit more money that should be applied to reduce the United States deficit.
Mommy, you know, my mom, she has this little part-time job, and they took $3 extra out of her check, you know, for taxes, you know, because she ain't making them. But I'm just saying, you know, she was like, she missed that $3. Like,
well, her employer are regulated by state and federal regulations, and they must comply with them.
Yeah, yeah. Well, give us some magic wand tricks that we can, you know, help ourselves. Well, you just did.
Well,
Dial zero.
Yes, absolutely.
Dial zero.
Now, I even tell my married couples to claim single on their W-4 form. That has nothing to do with how you file your income taxes. Whether you file single or file married, it only relates to the rate of federal income taxes that will be held. If you claim married, less taxes will be held. If you claim single, more taxes will be held. So I like to be prudent and prepare my clients to anticipate a refund. I just don't like it when they have to pay back. You know, and I've had a tax client just this year that owes Internal Revenue $10,000.
They need to call that. There's a commercial one.
Yeah.
You owe $10,000 or more.
Yeah,
We can help you.
Well, you
got to
watch those firms too, because their fee is very high for their service.
You might not owe the IRS that amount, but you're gonna be owing them the rest of your life.
I know generally attorneys' fee is 33% of whatever award you may be entitled to, okay? And I believe those income tax preparers who claim that they can do this and do that, they're negotiating with IRS, okay? And your taxes will probably come down. But whatever the bottom line is that they have negotiated with Internal Revenue, that they have saved you, you're going to pay 33% of that amount.
Yeah, okay.
All right. Now, there are one other form that I want to discuss, and that's the earned income credit form. Earned income credit. Now, this form is called Schedule EIC, Earned Income Credit. Now, this form has become a lot more stringent in the last couple of years, particularly for tax preparers, because there are a slew of questions and certifications that the tax preparer must ask of the taxpayer to certify that he's asked the appropriate question to make sure they are entitled to the earned income credit. Earned income credit goes to a household that makes under a certain amount. Let's say for the whole year, your income was less than $27,000, and you had a child. Well, you qualify for earned income credit. And as the preparer, I would have to ask a certain question, like the name of the child, the social security number of the child, the child's date of birth. Was the child under 24 years of age at the end of 2012? Was it a student? Was the child permanently disabled or not? You have to verify that the child was, what relationship the child was to you. And it can, to qualify for earned income credit, it has to be your son, your daughter, your grandchild, your niece, your nephew, or your foster child. A grandmother would not apply. It only relates to a qualifying child that you claim on your tax form.
Now, what's the difference between this one and the tax credit, the child tax credit?
Because the child tax credit applies to any child under the age of 16.
That they don't even have to be related to you? I mean... Child,
I said. A dependent child.
Right.
A dependent child.
Okay.
It has to be your biological child.
Okay. And this one?
This one, for the earned income tax credit, yes, it has to be your son, daughter, grandchild, niece.
So I'm trying to see what's the difference between this form and the child tax credit.
Because they are two different approaches to receive a credit which reduces your taxes. So you can qualify for both.
Both of them. That's what I wanted to know. Okay.
Yes. One has no.
No wonder these women keep having these babies. Let me stop.
Well.
I better go have me a couple more. Let me stop. I'm kidding.
Well, you would have 18 years.
Hello.
You would also have to certify that the child lived in your home for 12 months. If it's a single lady, she has to identify where is the other parent, where is the father of that child.
No, really?
You have to certify
that particular form
on that earned income creded. Yes.
Okay. Okay.
You have to identify, well, where is the other spouse? And did the child live with that other spouse anytime during the year? Could that child be claimed by anyone else? Okay. So there are a lot of questions that the tax preparer must ask of the taxpayer to certify that they qualify for all of the issues relative to the earned income, the tax credit. Also identifying the school that the child went to, whether he or she has any disabilities. And you must also be able to certify that you can provide medical receipts, school receipts, social service receipts, church receipts, attesting to that child in your household.
Okay. Well, this has been wonderful.
Oh, good.
I really, I mean, I'm sure that this is going to be an absolute blessing to a lot of our, you know, viewers, and you know, and we really appreciate this, because we really do have to, you know, we all got to pay taxes, and we might as well try to get the most we can out of it, you know.
Yes, you're going to pay taxes. And a lot of people ask me, do I have to pay taxes after I get 65? Do I have to pay taxes after I become 75? Well, the answer to that is yes. Tax is not an age criteria. Taxes are based on an income tax criteria. So as long as you have income coming in, you're going to pay taxes.
From any source,
From
whether
any
it's
source.
even when you retire and getting your pension, you got to pay.
Your pension is taxable income.
Wow.
So make sure that whoever your pension provider is taking out the appropriate amount of taxes for you. Okay.
All right. Well, there you have it. And what is the deadline for the taxes this
Well, the
year?
tax deadline is April 15th.
April the 15th.
April 15th is the standard deadline for taxes. And if you allow me, oftentimes people tell me, well, Claude, I don't have all my paperwork together, I don't have my expenses together, will you file an extension for me? Well,
I never did that.
I know, no, you haven't. but an extension allows the taxpayer time to submit their taxes.
Okay.
It allowed them time to submit their taxes. But me as the preparer, I still have to go through the process of completing their taxes, even if it's in an anticipated mode.
Okay.
It's not it's in a draft mode, not a final mode. But even in that draft mode, if you owe, your extension does not give you a pardon for paying on April 15th. Your taxes are due on April 15th. So I would still have to go through the notion of preparing a draft tax. And if the bottom line is that you owe that amount is due on April 15th. Obviously, if you go through the draft preparation and you're anticipating a refund, then that's no problem. If you're anticipating a refund, the April 15th deadline is not a deadline necessarily for you because you're anticipating a refund. They have your money.
So you can take your time.
So you can take your time. Theoretically, you can take your time. But if you owe, they want their money on April 15th. And by doing that, you will eliminate any type of penalties and interest. And as I close out, I just want to say there are people who owe, and if you owe $5,000–$6,000 at the end of the 2012 tax year, don't get paranoid. Don't go jumping out of a window, okay? Because you can always apply for a payment plan.
Payment plan, yeah.
And you submit a payment plan, just be committed to the payment plan that you have subscribed to, and more often than not, Internal Revenue will accept your payment plan. And you eliminate penalties.
Okay, that's good. Okay, one more question with regards to the extension. Now, how long can you do an extension? Because I know I was in a situation one time where it was discovered that, oh, I forgot, you know, I could have claimed this too.
Are you talking about an extension or an amendment?
Okay, never mind. Cut now. Okay, an amendment.
An amendment.
An amendment. Okay, let's talk the amendment.
Okay.
How long do you have, like after you filed your taxes and everything, and you discover, oh, I forgot to claim.
Well, you can always do an amendment. Amendment could include, I forgot to include my property taxes.
That's
Amendment,
a big one.
Amendment could include, I forgot to write off my child's daycare center's fees. Okay? Now, you have 3 years from the date that the taxes were due to submit an amendment. For instance, if you discover that you omitted something on your 2012 taxes, the season that we're in now, you submitted it, but you discovered that you omitted something, which entitles you to an amendment. Okay, your 2012 taxes was due April 15th, 2013. So you got 13, 14, and 15. You got to year 2015 to submit your amendment.
All right, that's excellent. That's excellent. Well, ladies and gentlemen, let's give our Mr. Claude Wallace.
Thank you. It's been my pleasure. I hope I've been informative to your listening audience.
Absolutely.
And they can feel free to seek income tax services preparation, primarily at a professional service. Or you can find them in the Yellow Pages, or talk to your friends.
That's right.
That's
word
a very good
mouth.
point of reference.
Word of mouth.
Most of my clients come from word of mouth.
Absolutely, and that's the best.
That's the best way, because they have confidence in the preparation of their taxes so much as to refer them to you. So ask your friend.
Claude, Mr. Claude L. Wallace.
Thank you. It's been my pleasure being here.
Thank you so much, Claude.
You're quite welcome.
I'll see you soon with my box of papers.
Should I say have a little?
You can say whatever you want.
Cookie's always welcome. with her shoebox of receipts. Good night.